This show is sponsored by iTrustCapital. iTrustCapital offers crypto IRAs as well as precious metals IRAs with no monthly fees and no hidden fees. iTrust has a wide variety of different crypto assets. You can trade 24/7, 365 days a year on the iTrust platform as well as their mobile app. And now with conditional buys and sells, you can walk away from your computer and automate your transactions. If you use my link, iTrust.capital/Darren, you can get up to $100 in funding rewards just by using the link. So be sure to check out iTrustCapital as well as crypto IRAs. What we must decide is how we are valuable rather than how valuable we are.
Off. And you've got to settle yourself, because you also, the other thing that goes along with this, number one thing I hear from people, anxiety. It's self-induced. You're worried because you're worried, and then you're so worried, and the next thing that comes up, you're worried about that. And so people are in this cycle, and then they think they're gonna make some money. I mean, how are you gonna do that? It's not even, I'm surprised some of these people are alive. Like, how did they made it this far? So you got to settle yourself down. This is really simple. You're in this big debt-based system. It's a perpetual boom. What I'm about to tell you is very important. This is a perpetual boom with the occasional crisis. Okay? You're in this long-term inflationary debt-fueled boom. It's not going to end until it explodes, which is not going to happen anytime soon. And you have these crisis events. Think about it. The COVID situation, the stock market lost a third of its value in like 2 or 3 weeks. And all of a sudden, the Fed comes out and says, we're going to buy junk bonds. What? We're going to buy junk bonds and stabilize the system and give everybody checks and all this stuff. Boom. It kicks off this gigantic rally. The U.S. markets were worth 25 trillion. Then they were worth 50 trillion. Okay. Yeah. So you got to see this. Now what you're doing, you went from 55 trillion to 45 trillion. You've come down maybe 15, 18%. You're probably going to go a little more because the Fed needs everybody to stop. The liquidity's coming out, right? So you have to have everybody a little afraid. Okay, wait a minute. What do we do? Oh my God, I got to...
The system requires perpetual debt. If more debt does not get issued, the world comes to a screeching halt and everyone loses. This cannot happen.
I believe that if a wall has been erected, you must think very carefully why you break that wall down. And so to just say we're going to disintermediate and disrupt and all of these terms, think very carefully. The world has seen the best times ever in the past, let's say, 2 generations. We've gone from, by any means in which you measure, if you take just, for me, the favorite measuring example is life expectancy. Take life expectancy across the globe, it's jumped up in the past 20 years or so. A massive reason for that has been economic growth and stability and sort of, accessibility of food. And there's a lot of work to do, don't get me wrong, but think very carefully before you break the banks, because access to capital has been a major, major push in terms of the developmental index across the world. So I think banks will change. I think they'll become more, we speak a lot in the decentralized finance world about decentralizing everything. At the end of the day, finance cannot be decentralized. It is one person making a decision based on who they trust. You extend credit based on who you trust. Yes, you can do that to a DAO, but still you have to trust the DAO. You have to understand it, right? Or the other way around. And that cannot go away. Banks are the method in which we do that, and they have an important role to play. So I would not like to see them disintermediate. I would like to see them change fundamentally.
The power structure of our society relies on fiat and banking, the ability to print money and create credit. This is not going away. Digital currencies will allow this system to continue with negative interest rates. The debt-based model will evolve, essential to understand how the game is rigged.
I've already stopped drinking, okay? That's the deal. So the rates have not gone up. The rates they're less than 1%, but there's a lot of drama. And so what the Fed's trying to do is strengthen the dollar. That's what they want to, they don't care anything about inflation. Like, I hate to tell you something. No one cares about inflation and about helping you. No one's here to help you. There's going to be no help, okay? All they're going to do is distract you. What the Fed wants to do is strengthen the dollar. So all these countries, when the Russia situation goes on, they were walking away from the dollar. You see Saudi and China, they're all trading oil and what? Okay, so the Fed says, if this happens, the whole Western system collapses. So we got to strengthen the dollar. So how do you strengthen the dollar? You create a dollar shortage. That's what's happening right now. The dollar's getting stronger against every other currency.
As the Federal Reserve tightens, markets sell off and investors sell their assets for dollars. This makes the dollar stronger. Countries around the world own U.S. debt, and a stronger dollar incentivizes debt holders to stay in dollars. When the USA sanctioned Russia, this caused uncertainty. A stronger dollar restores confidence.
I think central bank digital money will definitely happen. I mean, it's already happening. Congratulations to Nigeria and a few other countries. We're working on projects that are pilots prior to going live, so not proof of concepts. I think proof of concepts should be a thing of the past now. And the big question really is what happens in the middle. You know, the commercial bank sector, and whether that will be, ultimately stable coins or some other form of digital money. But digitization is happening. You can't turn back the clock. You can't, change the future of the world. It's going to happen at some point. And there definitely will be coexistence based on rules, based on use cases, and a bunch of other things.
Every time the Fed raises interest rates, something breaks and they are forced to lower. And each time this happens, the money printing becomes more extreme to keep the economy alive. The next time they lower, they will need to go below zero. To do that, they will need a digital currency. Now, you heard James Wallace, the CBDC director at Ripple. He says proof of concepts are now a thing of the past. They have moved to a testing version. Next will be implementation.
The dollar, of course, is the leading world's reserve currency. They are related to each other. No country wants, in this environment of relative depression or relative lower prosperity, no country wants to see its currency go up too much. So the fiat currencies, this tends to be a fair amount of printing of money and then a lowering of that. We are in a temporary period that I would say will probably last 6 to 12 months of a tightening in monetary policy, but that will be the correction in the trend. That tightness will produce weakness in markets to be followed by weakness in the economy, to be followed by another round of easing. So I want to be clear, the printing of money and the large debt will have a correction as there is this tightening coming up, which will be probably over the next 6 to 12 months. But you'll have that. So as a storehold of wealth, and by the way, they won't bring interest rates during that tightening to a level that will compensate for inflation. So you'll still lose money to inflation, which it means it's still better off in those inflation hedge assets.
Ray Dalio estimates that this tightening phase will last 6 to 12 months before we go back to money printing. He's saying that the Fed will fail at curtailing inflation. When this happens, the markets will continue their uptrend. I believe it will happen at 2% interest rates. We are currently at 1%.
I think what the markets have taught us of late is that it's really hard to predict. I think most of us thought we'd see green all day on the screen and not see this whipsaw that we've seen in the equity markets. It feels to me like we're sniffing around for a bottom here. It feels to me like we're getting to a point of capitulation. I think what you're seeing certainly in the crypto markets is a lot of momentum and speculative investors who are getting flushed out here. We see from our business standard custody and trust a lot of interest coming from institutions. We just had a very large prospective investor come in today who feels like it's the bottom and they're looking to move into the space. And so I do think there's a lot of pent up demand. I keep reminding myself when I do my own gut check here is that the longer term fundamentals have really remained unchanged. There's nothing that we've learned fundamental to the crypto long term story that I think has changed over the last couple of months here. We have the advantage of seeing what institutions are doing day in, day out, and big major institutions globally believe in the long-term trend, not only around the underlying blockchain technology, but more importantly, around digital assets. We are in the process of really rewriting a new operating system for capital markets. And I think that longer-term thesis will ultimately prevail, and that the higher quality tokens and assets will prevail as well.
And then just finally here, there's been a lot of analyst calls for the second half of 2022 to see a rebound in crypto. And of course, you don't have a crystal ball, but is that what you forecast as well? Do you think that we will see a turnaround?
Unquestionable. I think the hodlers are going to remain steady. That's certainly what I've been doing. And as I said, if anything, I think the real money that's going to be coming into the space views this market drawdown as a real opportunity for the longer term. So I remain very, very bullish.
Major institutions have invested billions into crypto. Crypto assets are operating systems of money. Eventually, everything of value will be hosted on these protocols, making value native to the internet. Jack says the higher quality assets will prevail. In other words, utility.
A bigger percentage of the money supply than central bank money is today, whether that has an impact on banks' ability to do lending, right? I mean, that's another whole big topic. I think it's in the interests of the central banks and governments to provide an environment that's stable, right? And we've seen in the US, it's clear that the Federal Reserve Board and other sort of stakeholders in the US will be working very closely with the major banks to figure out how a CBDC will happen and how it will get implemented. So I don't think there's going to be wide-scale disintermediation, but I think the banks are going to need to lean in and take advantage, and those that sit back and don't, they'll suffer.
The big banks and the Fed will have to iron out what a central bank digital currency looks like. And to keep the banking system, they will need to innovate. They won't be hiring developers on their own. They will need help from the experts and subcontract innovation in order to stay competitive. Only science can hope to keep technology in some sort of moral order. Thanks everyone, I hope you enjoyed this show. If you enjoy content like this and wish to support my channel, please consider joining my Patreon.